Thank you. Where should I?
Anywhere up here.
So just to begin, I'll start with a correction. I'm no longer the head of AI and banking for capital markets at Scotiabank. It's a long story. I'll tell you the story, but you'll get a real sense as to how all this stuff works. It's a good story. It has a good ending. So I'm Taha Jaffer. Nice to meet you. We have about 20 to 30 minutes together, and 30. And the hope for me today for you is to give you a sense as to what's available in the banking and financial industry for people with a strong maths background, as well as I'll give you a bit of my life story. All right, so you kind of get a sense as to how maths fit into pretty much everything, right? And maybe not what you're thinking, but you'll realize there's a lot of opportunities everywhere. I think you'll also note, and I think the most important question that you're probably all thinking about is probably jobs. There's always hiring going on, as much as there is firing going on. There's always shifts around the organization of people moving things, right? And what most places are lacking right now are things on the engineering side, as opposed to the ideation side, which is where the math comes in. But what we're finding now is that for the past 5-10 years, there's been so much investment on the engineering side of things that opens the opportunity for now the brains to come in and start now fitting things together. So my background, I actually am a Fields Fellow. As if I don't know if it was advertised, but I was put on the list last year. And it's my work I did with the COVID task force here. I work with Kumar directly in providing some of the projections that were put up. So if you're ever there in COVID when you're in Ontario and you're listening to those news items, and you know one of those fellows was up there, the chief science officer was up there talking about, here are the 3 projections, right? There was one from a team in Waterloo, there was one from a team in York, and then there was me. And it was just totally bizarre because nobody knew it was me, and I didn't want anybody to know it was me, just in case it was completely wrong. But at the end of the day, it turned out to be right 6 times, early in every case, with a lot of things going on. And I could not have done it if I hadn't had a training in math, and I didn't have a training in applied math and a training in other things. So my background, I have a PhD in electrical computer engineering. My undergrad everything is here at University of Toronto. I have my undergraduate is engineering science with a physics background. I pretty much am a maths person, but I ended up in applied math. But I also did 2 master's degrees, one in biomedical engineering and one in mathematical finance. So when I exited the university, I got an opportunity right away to work into the hedge fund area of Canada and the US. And that's where my career just took off. And what I got hired for was really weird. At that time, I was working for the largest hedge fund in Canada. So this would be around 2001, 2002. That's when I graduated. And they were trying to build something in what they were calling decision sciences, or things to help build systematic views of things. Now, I don't know how much you guys know about economics and finance, but there's a very solid foundation of what they work on, right? They do a lot of Monte Carlo, they do a lot of random walk type stuff, and that's essentially what is the foundation of a lot of modern finance. But what these guys wanted to do was things that we would see in engineering more, which is like connected systems, right? Networks of things that have delays that then pass things on. So there was an entire area of study back then called systems dynamics, which was trying essentially to put a rubric around creating, coupled differential equations, but in a way that you could kind of get your mind around, right? So this is what they wanted me to do. And again, I was coming off of a co-op at Manulife, and again, Manulife has a need for a lot of math, and at that time they were doing a lot of work on some insurance products. But again, I got introduced on the capital market side, and so my boss went and joined this hedge fund, and when I was graduating, he told their guy, well, if I'm coming here to start a research group, you should go get that young guy that's over there. So that's how I ended up there. But I was in this program where I was now developing these coupled PDEs, but nobody called them that. No one talked about them that way. No one thought about them that way. And the beautiful thing was that I had to make sure they were linear so everybody understood what was going on. So it was like the easiest of the easy, right? All you had to do was really calibrate things to what you actually saw in reality. But that then ended up becoming a whole career. I spent about 7 years there. I spent a lot of time moving around the firm. And so at that time, that firm had two key businesses. The first business was in what we call synthetic indexing. It was the first, I guess, fund in Canada to actually get Tax Canada to say that if you buy a futures, you don't have to pay anything on it, because a futures contract is essentially worth nothing until it actually moves. So they got the tax ruling and they created an entire business out of that. So I got involved in that in a big way, not only in terms of creating things around it. And so again, that's where the math comes in, because when you're creating these structures that you hear about a lot, the things that blow up markets and blow up countries, the way you connect these things together, it requires a lot of math. How you stress test them, how you think about them, requires a lot of understanding of applied math, right? So I got involved in a lot of that. I got involved in the other side of the business, which was what we call illiquid investing. We would go out and we would buy hedge funds. So we were a hedge fund, but we would go out and buy, shares in other hedge funds, and we put them together. And so it was like a fund of hedge funds. So it's like a mutual fund for hedge funds. And in 2002, that was like the best way for a CPP or a teachers or a hoop to get into that business, right? UTAM, which is University of Toronto's endowment fund, was one of our investors, just to give you an example. And so they ended up, because of my background, the fact that I had a PhD means I could go into a room and I would balance off the other PhD. I didn't have to say anything. I wasn't there for any other reason other than to balance the person off, but that was what it was. But then we found quickly that it was very easy for me to understand how these things work. Because I'm used to thinking about the connection between things, right? How all these things are connecting together. So I ended up having a very fruitful career there. And around 2007, decided I wanted to try to get my feet on the front line. So I'd spent now 7, 8 years in research after, like post-grad. And I wanted to get out and actually get my feet onto the front lines. So I got a job at another hedge fund here in Toronto to be their director of research. And the day I walked in was the day one of their guys walked out, who was one of their portfolio managers. And I said, well, okay, you're also going to manage this portfolio. I said, but I've never managed a portfolio before, right? I said, it's no big problem. It's no big deal. You can manage it. So I started off on this ambitious research agenda on managing and trading derivatives, but then I had to manage this other book, which was what we call a market neutral portfolio. I don't know, just show of hands. Anybody know what that means when I say that? One hand, two hands? So basically, you're probably familiar with buying stocks, right? That's what most people will do. But what these hedge funds do is they will do something called short selling. Okay, so this is a way for them to say, well, look, we also have good ideas on the long side for things to go up, but we also have good ideas for things that should fall in value. All right, so you can couple that together. You can't buy the stuff that just goes short, that goes down, because you'll lose money. So what is a common practice is what you'll do is you'll go buy some shares in something, sell them in the market. Sorry, what they call is shorting. You'll borrow shares from the market, sell it, make some money for this, and then return it back later. It's this idea of being able to balance off the longs and the shorts. And if you do it really, really correctly, you can create a portfolio that's a market neutral in its risk profile. What that means is the market goes up, it doesn't matter. It'll go up or down. If the market goes down, it doesn't matter. It'll go up or down. But being able to calibrate the risks and think about the risks, it's actually a very deep technical problem, but as well as a very deep applied problem. And so that's the book they handed me. I'm like, great. I was doing a little bit of that in my old role, so it wasn't like it was completely foreign. But this is 2007, right? And so as 2007 is unfolding, my research in the derivatives, which is highly mathematical, highly technical, and then highly applied, was off the ground as well. So I was doing a bunch of different things. Then the crisis started to hit. I think starts in the summer of 2007. It gets really interesting midway, sort of three-quarters of the way through 2000, and then things really start rolling over in early 2008. Now it turns out I was in absolutely the best position I could have imagined, even though it was absolutely bananas, the whole situation. I was trading volatility. The world was now turning into a volatility monster. I made so much in those 2 years I was there. I think my track record, I think I had 24 months there, 22 were positive, one was triple digit, 1 month was triple digit, I think 2 months were triple digits, 1 month was quadruple digits. It wasn't easy. I learned in my first month quickly how to manage the risk, because if you're up and down 40% in a day, 50, it doesn't feel good. So you have to understand yourself. All of the work that you've done to pull these things together, you quickly understand in the real world, there's meaning to it, right? And then you have to deal with that meaning. But then this market neutral thing, it just ticked along. And over the course of that entire crisis, I think it was up like 5%. And they were calling me a hero, right? And I'm like feeling great, but I didn't do anything. I'm just managing it for them, making sure that the stocks that are going in are going in, the ones that are going out are going out. I didn't do any of the research because someone else is doing the research. And then March 9th comes in 2009. It's the bottom of that market. This book, this market neutral portfolio, that's supposed to basically make, a couple basis points, percentages of percent a day, was all of a sudden losing like 1% a day. And it wasn't like it was one day it's up and one day it's, I was like losing. Everyone's looking at me, what are you doing wrong? I don't know, right? But now I'm learning now how the world works. It's not just the math, there's more going on, right? And so after about 10 days of this, I think the book was down about 10%. And I didn't know what was going on. So I went in there and I started managing risk. I said, okay, there's clearly some hot spots, right? We're just gonna pull them out. And then we'll do a bunch of other things, balance it off. Book stopped losing money. We stayed at -10. We didn't go up, we didn't go down. And then so about 4 months later, I got called into a room to say, okay, let's do a post-mortem on this. In reality, they were trying to fire me. You lost 10% off a book that shouldn't lose 10%, you're gone. Even though I'd done so well on the other stuff. So it turned out that nobody knew what was going on. No one knew what was wrong. And so we all agreed, why don't we just let the researcher, the one who did the work, just go and assume that I didn't take out those things. What would the losses have been? Or the gains? Could be the other way too, right? I was more than happy to take my lumps if I made the mistake. I couldn't withstand a book like that being down 20% or 30%. They went back, they did the work. It took them like 3 weeks. They came back and said, we would have been down 50. How did I know? I didn't, right? I just, after having now dealt with all these derivatives and the up and down, it's just more prudent to cool it and let it kind of figure out what it's going on. We found later what was actually happening was that they hadn't built a market neutral portfolio. What they had done was they had eliminated a bunch of market risks, that they weren't measuring all the market risks they were trying to take out. And they actually lined themselves up on another one, right? The exact kind of one that does well in a crisis and does really poorly coming out of a crisis. But they didn't know because they had built this with data that wasn't going through a crisis. So this is it's one of those lessons. And again, it comes back to now understanding how these things interconnect, right? And I think that also comes back to having a mathematical sense of what you're looking at, because those numbers mean something. Whereas people on the other side who are reflecting all this back to me, they're more business people, they don't get it, right? And I'm telling them, no, they talk about correlations breaking down. Well, they don't know what that means, right? They just say it because it makes sense and everybody else is saying it, so they say it. But I'm telling you, well, we don't measure a correlation with that. It's this process that it's smoothed over. And yes, there's an error band around it. Nothing is about breaking unless you're completely wrong, right? And even then you have to test how wrong you are, right? So lucky for me though, another firm came knocking on my door. They had heard what I had done on the derivative side. And so I ended up going and joining this company called DGAM to manage their tail hedge portfolio and create the whole risk framework around managing the tail hedge. So I thought initially that they had something. They said they survived the crisis. Everybody else in their peer group was down 20, 30%. They were down like 5, 10%. So they survived. And they said, well, we did something on hedging our risk in the tail. We think we can do something better though, and we'd love you to come and be a part of that. So I said, okay, that sounds great. I thought I would be walking into a situation where they had a lot there. There was a great structure. They had thought this through. No, nothing. It turns out how they did it was they had an inkling that something bad was about to happen. They went out and bought some deep out of the money puts on a variety of things. So they were very intelligent on what they bought. They did a really good job there. They got in early and then they got out early. So I remember talking to my boss afterwards, like, well, how did you guys only make like this much? You should have been up like 40% in this situation, right? And he goes, well, we all kind of had to have a heart-to-heart moment in all these situations, right? We needed money, we needed liquidity. This was coming from here, this was already done. And we thought that was the end, right? To a point. So in their defense, I think they did a really great job, but I think they could have done a far better job. And so the first task they gave me was, can you measure the risk better? And I'm like, well, you know, the nature of that firm was a really interesting one. They only really invested in things that are arbitrages in the world, right? So arbitrages are things like those long-short portfolios. I can't just go out and buy a hedge for that. These are very complex things. Nobody actually has it. So I have to kind of figure out, how do I create an insurance program around something that you can't actually buy or sell directly? So it required a ton of thinking. All that training I have, both on the maths and the applied math side, came to bear. And thinking about extreme risk was the key to it all, and how they all ultimately connect to one another. So I had a very deep networked view of all this that in the tail ended up becoming linear. Again, how would I have gotten there? I wouldn't have been able to get there if I didn't have a background in being able to model things. But I ended up coming up with this process where we would go through everything that we held and we could translate it into this framework, right? It's like this framework where it actually talks about these deep risks. But once we have that, we can now line them up against things that we can actually buy. So again, my claim to fame there was when you do an insurance program, you tend to lose money. We ended up making money throughout the entire time I was there. I turned their costs, which they were spending on their insurance, they were spending about 2% a year of everything they make. I think we ended up spending like 40 basis points a year. So it was a dramatic cost reduction just by being thoughtful about how you model those risks, right? And like I said, I helped them through. Then after 2009, there were just crisis after crisis after crisis. So in every one of those crises, everything behaved like it was supposed to. Again, the maths that we'd built in, the systems we put in place, everything worked flawlessly. So you know, I did very well. And then again, I got involved in pretty much everything, and my success was borne out by my rise in the organization. I ended up having veto over I got to the investment committee, so basically at the level of making decisions, and I had veto over everything liquid or liquid going. The only other person who had that power was the CEO, right? Just because I was involved in everything, right? So that ability to see those connections, even if you think it's like abstract, just the abstraction of these complex things, the ability to do that, and I think that a strong characteristic of everybody in this room is something is completely intangible and hard to price and hard to value. But that's, I think, one of my abilities, and I was able to bring that to this, and I could take that across the board and up as I started getting more and more experience. So to cut a long story short, we got bought out by Carlyle, ended up, and that's one of the largest alternative asset managers in the world. Ultimately, I found myself looking for work later on because I started my own hedge fund. It didn't work out quite so well. Another long story, not for performance reasons. It comes down to business reasons. Again, maybe I'm not the best business person in the world, but performance-wise, I was knocking it out of the park. But as I started looking around for work around 2017, 2018, a lot of me going on the street was hard to absorb in that street. Everyone I would go to, they would just say I was overqualified for pretty much everything. I think now we were gone away from the world of hedge funds, and all this money and research had moved into the land of the endowments and the pension funds. So you don't find, if you come in and you look in Toronto now, you're not going to find too many hedge funds, like very few. And back when I was graduating, there was a lot. You can walk around and everybody was willing to talk to you. But now all of that mental energy is in the pension funds and the endowments, right? So when I would go to those places, interview there, you're overqualified, like for much of what we want to do. And I was getting great references and things, but So just to give you a sense of parallel to the job search, even with all the experience and all the qualifications, it's not easy because you have to find a place where someone actually needs you, right? So I ended up taking my resume, and you're gonna laugh at this. I took my resume, I took out all my investment experience, I just cut it right out, just worked with my technical. Then I started getting calls all over the place. In Europe, a few hedge funds in Europe, a lot of interest around here because, again, like I said, at that time in 17, that was the big AI buzzy time, right? They were hiring professors to do nothing and paying them $2 million, right? This was the time. There was a frenzy. Like you think today there is a frenzy on ChatGPT. That was a frenzy. So I ended up getting hired. I took a job to build out my network again. So now this is another lesson for you. That my network before was in the small investment space. Once I started looking for something, I couldn't actually get anything from it. There was a boundary that I couldn't go beyond. So I took this job with a friend of mine who was the EVP for digital at TD, and you know, he said, come in for 6 months and help us build a organizational roadmap for AI. And so I asked him, well, why? I'm not a consultant. I don't. He said, you're the only person I know that has used AI, right, to make money, right? And you have a track record to prove it. I said, yeah, that's true. But I went in my first week, I put a presentation together. I put it in front of these guys. They couldn't get off the first page because I just went in there saying, AI is going to eat your lunch, and if you're not on it, you're going to lose. They didn't get off the first page. I had 10 pages, and they're like, no, this is not the message. You know, this bank has been around for, I forget what they said, 100 years. You know, every year someone says we're going to disrupt your business, right? Last year it was digital payments, and Apple was going to disrupt our business, and it never does. And if they get close, we'll just buy it, right? Because we make $10 billion a year. They bumper profits every year. Okay. So I had it wrong. I said, okay, I have to think about what I can do to this. So I made the pitch, a really simple pitch. I said, okay, my background is hedge funds. I think hedge funds are the perfect business model for how you best extract value out of information. Because that's what they're set up for. Everything is squeezed so that they can boost their profits as best they can, right? Make it as efficient as they can. So I created a whole roadmap around this vision of, okay, well, this is what a hedge fund looks. This is how they hire. That's how they do things. That's how they move things. It became the vision document for all of TD. All of TD. Like, so this is weird, right? In my first month there, an AI outfit came for sale called Layer 6. And my boss, who is the EVP of digital, was the one leading the charge. So who did he turn to lead his charge? Me. I'm just a consultant. I'm there for like 6 months, right? In one month, we ended up putting the entire presentation together, getting all the merger things together, valuing all the IP. Again, I did that in my old role. I've done all these things in my old role. And we were able to actually bring Layer 6 into TD, and it was staggering. Not only from a point of creating the business vision and how it's going to go, but then how it all fits into things. So then at that time, as I was wrapping that up, I had some conversation with some folks at Scotia who heard what I was doing at TD and said, oh, why don't you come over here? We have a AI lab that needs a director, right? And I said, well, it's a bit junior for me. And they said, well, that's okay. You know, you will love it because you get to manage some people, but you also get to get your hands dirty back and think, oh, that's true. I do like actually doing work, right? I like to think about these things. And so I joined the team in 2018. And so I ended up becoming the head of AI that was there for what they call capital markets and treasury. So we had 4 major teams. One is for the Canadian banking on the retail side. So this is all AI, machine learning, you know, alternative data, everything that is synonymous with pushing the envelope. All these teams were doing, right? I was the one in charge of anything that touched capital markets. And we had about 40, 50 people in that team. So it was quite a big team. And a bunch of projects that were coming in. We were self-sufficient. We were paying for our own things. It was great. And then all the organizational shuffle started to go on, right? And I ended up being the head of that team, that whole thing, for a long time. To the point, and I won't go into the details of how everything works at a bank, but I spent a lot of time not only connecting people with what we could do, and then getting these very, very intelligent people who work for me to connect into them. So they had backgrounds in operations research. They had machine learning backgrounds, data science backgrounds. Some were just data engineers, right? But everyone came from something, biostatistics. We weren't just interested just in PhDs, right? Anybody that has the ability to think in a bit of a white space. Like the biggest problem for me was finding people that could go from A to B, but you know, kind of figure it out in a meandering path that kind of gets there. The biggest problem was we had people who would just go up and then over there, and then to bring them back, it's micromanagement for me. And I can't do it if I have 40, 50 people, right? It's very hard. So we started to just change the mentality to make it something like that. And that's kind of if I was hiring, that's what I'm looking for, right? People who can do that. And it doesn't matter if you have advanced degrees, no degrees. Our most senior data scientist just had a master's. And everybody said, you just got to keep getting rid of them. I said, well, this is the best. you got to keep them, right? Same thing with a bunch of the others. And so we ended up doing quite a bit of stuff. But again, because I have this background in physics, an opportunity came for me to go and kick some tires on a quantum computing shop here in Toronto called Xanadu. Scotia is an investor in it through another one of our partners. And at that time, the CRO of the firm, Daniel Moore, who claimed to fame as algorithmics, and again, brilliant mathematician in his own right. That's why you see there's like a group of people who kind of get together and kind of get along, and if they have the same mentality, you kind of all stick together there. So he was like, why don't you go and just go take a look? You have a physics background, tell me if it's real. And I was coming from TD where they had a very poor view on it, right? And honestly, I didn't spend that much time, but I went there. And you remember, I have a physics background, so I walk in there and it's just a bunch of optics benches. Like, this is nothing cold. They say, yeah, the only cool thing is like in that room over there, the last bit of the detector. And then I started listening to them and understanding how they were entangling things and coupling. And I went back and I said to Daniel, I said, well, if quantum computing is a game changer, this could be the game changer of the game changers. And the reason is they were doing it at room temperature. They were not using ions or trapped ions or anything that's hard to manage. They were using, they were coupling photons together. They're bringing them close enough that they could then be entangled and then you can do things with them. And all of their infrastructure was on the photonics infrastructure that is already incredibly well commoditized, well priced, well supplied, right? The only thing they had a hard time with was ultimately detecting the photons at the end, is where they had to have their cold thing. And then they were building an entire infrastructure, and I'm like, yeah, I think we should give this a go, right? And so he said, well, can you find me a project? I said, okay, I'll go think about it, right? Because it's not like you're talking about a huge capability, it's a nascent capability. So we ended up finding one that internally was really hard to do. It's a graph problem, but it was directly related to something in our business. And I said, if we can do that, then we definitely have something, right? And we can show that there's value on the quantum side. But again, and I'm just bringing it back to the center, it comes down to being able to understand the maths, understand what's going on. It's not me as a business person going in and saying it's valuable, it's me as someone who understands what's happening, saying I think something is there. And I was able then to take a calculated risk. I said, well, I think my understanding is correct. Let's try it. So I think ever since, I've kind of been the de facto head of quantum for the bank kind of thing. Nobody ever says it, but whenever it comes to it, it comes to me. At the same time, I've been doing a lot of the AI, the machine learning, and a lot of my value today, as I've, it's been almost 20 years since I came out of school, has been more about connecting the idea to the process, because I understand the entire chain, right? It's not that I understand the business proposition. I understand it if my team can't do the work, I'll pull up my sleeves and I'll do the work, right? And I'll get it to the end point. So I think that's the value proposition I brought. And so in the, one of the things that I would do as my own side project, because I have a trading background, was I would work with some of the traders in the firm. The guys who were managing the bank of the bank. That's what Treasury is. Treasury means bank of the bank. All the money comes from all these places that comes into the Treasury, and then it gets dispersed from the Treasury. And they were managing the risk of the funds they had to pay out versus the funds that were coming in. The largest balance sheet in the bank. They had $1 trillion on one side and $1 trillion on the other side. And the middle, the difference between the two was about 100 billion. So I still can't compute the zeros, right? I see numbers, I still can't compute them. And I helped them with some of the AI models that we were building using bank data, using alternative data to help them predict changes in the interest rates coming into COVID, the point period coming into COVID, during COVID, out of COVID. And it netted for the bank an incredible sum, like in real dollars, just being able to manage the risk thoughtfully. And so the EVP, so if you think of EVPs, there's the CEO and then there's EVPs. It's like that's how lines go in the bank. And then there's SVPs and then VPs and then everybody else. It's very hierarchical. That EVP of that team said, we need to really double down on a capability like this. We really need to do this. So he went to my EVP, who was like 5 levels above me, right? And he said, we want him. Let's bring him over here to do this micro intelligence using AI and anything we want. So the quantum computing was big part of that. And I got traded like a hockey card. Like, okay, you go there now. And so that's what I'm doing today. I'm spending a lot of my time looking at pretty much anything and everything under the sun connecting it with anything state of the art or better in any area that people basically think of as impossible. And I'm trying to make it come to bear on our ability to understand and figure out where interest rates go. After all, a bank is a business in the business of making interest rate widgets, right? So that's what I do today. So my time, I think I'm over time. I'll pass to you guys if there are questions or anything else that you want to ask. Happy to take them. So I can't speak for the banking industry in 2001 because I wasn't